The stock market has indeed faced a daunting hurdle, experiencing what many are calling its worst day in years. Major indices have suffered tremendously, with the Dow plunging nearly 900 points. This alarming drop leaves investors feeling anxious about what the long-term effects might be. As we delve deeper, we see major tech companies grappling with sharp declines in their stock prices. Notably, Tesla's shares dropped by a staggering 15%, while other tech giants like Apple and Microsoft followed suit. This disturbing trend emphasizes just how vulnerable the tech sector has become amidst mounting fears. In an unexpected turn, President Trump has acknowledged the looming possibility of a recession. This admission hints at a transitional period as the U.S. economy adjusts to new policies. It begs the question, what does this mean for our future economic stability and growth? Market analysts are increasingly concerned about the unpredictable tariff policies that could potentially derail U.S. economic growth. The uncertainty surrounding these policies has already sown seeds of instability in the market recently, raising eyebrows among investors. The recent decline in the S&P 500 is particularly striking, reflecting a significant drop in market confidence. This marks the largest decline seen in 6 months, signaling a growing unease among investors as they navigate through these economic uncertainties. Several key factors contribute to the current market decline, with high stock valuations and disappointing corporate earnings at the forefront. Companies like Tesla have faced substantial losses, and this has weighed heavily on overall market sentiment, leaving many to wonder about the future. The impact on the technology sector is undeniable, with stocks such as Tesla losing substantial value. Other heavyweights like Apple and Nvidia have also felt the pinch, raising concerns about the future of this critical industry. As worries about a potential recession grow, the Trump administration seems to be adopting a more accepting stance toward market declines. This noticeable shift in attitude may very well influence future economic policies, stirring curiosity about the possible repercussions. In the midst of these market downturns, the White House remains resolute, insisting that the economy stays strong. They express optimism about future growth potential, but upcoming inflation reports and Federal Reserve decisions carry significant weight for investor confidence. As if in a race against time, negotiations to renew the United States-Mexico-Canada agreement are beginning early. These discussions highlight the urgent need for trade talks among North American countries, as they are crucial for maintaining economic stability. President Trump's approach to trade negotiations is also noteworthy, featuring tariff threats aimed at addressing issues like illegal substances and immigration. This reflects a broader strategy for fair trade, yet his administration's goals remain somewhat ambiguous, leaving many questions unanswered. Concerns over Canada's dairy industry protections and Trump's threats to close Canadian auto manufacturing underscore the rising tensions in trade discussions. These contentious issues could potentially have significant ramifications for bilateral relationships. In a surprising proposal, Mexican President Claudia Sheinbaum's administration has suggested raising Mexico's tariff rates on China, hoping to match the United States levels to enhance trade balance. This initiative seeks to prioritize trade with nations that comply with established norms. U.S. lawmakers from auto-producing states are advocating for increased tariffs on non-compliant automakers. Their goal is to protect domestic manufacturers while maintaining a balance in North American trade relations, raising questions about the implications for future trade agreements. The Trump administration's recent tariff initiatives, which include a 25% tariff on global auto imports and the suspension of certain tariffs, aim to rectify international trade discrepancies. These significant changes have sparked notable reactions from Canada and other trading partners. Following the Trump administration's 25% tariff on steel and aluminum imports, Canada responded by imposing tariffs worth $20.6 billion on U.S. goods. This retaliation illustrates the intricate web of interconnected trade relations that bind both nations. In a broader context, the European Union retaliated against U.S. tariffs by imposing a staggering 50% import duty on American whiskey and motorcycles. This move is part of a larger trade conflict that has emerged between the U.S. and its allies, stirring concerns for many. As the tensions escalate, China also retaliated against U.S. tariffs by imposing its own levies on American coal, natural gas, and agricultural products. This significant action underscores the global impact of U.S. trade policies, leaving us to ponder the future of international trade dynamics.